The banking system is the real wild, wild west. Why do I say that? That's been the narrative about the crypto industry since day one. And that narrative has only increased in volume as popularity has grown, as awareness has grown, and more mass adoption has grown. And why are they doing that? Right? Mainly because they want to keep you away from the crypto industry. But let's break this down. All right. They're saying that there's no regulation in the crypto industry. And because of that, it's too unpredictable. There are no safeguards in place. And it's very risky and not a viable asset class. That's literally what they're saying. Okay. Now, I'm not against regulation. I think it's actually a good thing going forward. But let's really see what's happened over the last couple of weeks to see what regulation has done for the traditional markets right now. All right. First thing here is that recent news is that the U.S. government has stepped in to save and says people with funds deposited at Silicon Valley Bank will be able to access their money. So basically what had happened earlier in the week was Silicon Valley Bank came out and said that, look, we're trying to raise some capital. I think it was about $2.1 billion that they were raising so that they could cover their costs. And that freaked everybody out, all the investors that were a part of Silicon Valley Bank, which has been in existence for about 40 years, heavily entrenched in the startup world and providing services and whatnot for startup companies. And so when people freaked out, the stock price tanked, which created further panic, which then everyone was trying to withdraw. And the thing about the banking system is they never hold the amount that you deposit. They never hold that. They lend your money out to 9, 10 other people. And so when you go in to withdraw everything, maybe a one-off is okay. But even if you go in yourself and try and withdraw 75,000, 100,000, maybe even 50, 25,000, they'll say, no, we need some time. And when you get a mass exodus of investors or depositors coming and saying, we want out, they can't cover that. And so quickly things cascaded to the point where the bank had to close. And so basically they have a regulatory body there that will step in, kind of like it's an insurance, and says that, hey, look, anything at $250,000 or less, we will cover you. If you're over $250,000, yeah, we're gonna give you a piece of paper, a certificate that says, hey, down the road, maybe you'll be whole again, or maybe some percentage of what you own you'll get back. So we're talking about a depreciating asset made of paper, cash, that you now have no access to, and you're giving another piece of paper that says maybe at some point in time we'll make you whole, or at least whatever we can, a certain percentage of that. That's crazy. This is what the regulation is a part of. This is what they're saying is not in crypto, so crypto is not a viable asset. Well, it didn't say these guys. So all we're talking about is a system where you cannot take money out as you will, especially as others are doing something similar at the same time. The system is not built for that. So what do? They first came out, they being Janet Yellen and the rest here, saying that, look, we're not going to bail out this bank. We're not doing that. There's a pretty hard line take that they took there. But then what happened was there was even more widespread panic. Now you got to remember, the startups that have been banking with, Silicon Valley Bank, this is a bank that's had 200 plus billion in assets. There's a lot of people depending on these guys to make payroll and do all kinds of things for their startups. That's gone. Like $250,000 is not going to do anything for many of these startups. So look, they're saying, oh my God, there's so much widespread panic. We need to save the entire banking system by stepping in. You just said you're not going to step in. And here's something that does not happen in the crypto space, is that there is no regulator to step in. There is no Fed to step in. There's no banking system to step in and say, hey, let's support you. They don't do that. And so when things like FTX and other exchanges like Celsius fall apart because there is no support, traditional bankers and the entire banking system looks at it and says, well, there you go. There's the problem. Meanwhile, the only reason things are being kept alive in these traditional markets is they just continue to loan money. Everything is based around debt. It is fake money. We call Bitcoin magic money. The real magic money is cash. It's printed ad nauseum, at will, with nothing backing it. That is true magic money. So look, they reverse course. They some of the points here is that regulators approve plans to backstop both depositors and financial institutions. So they came in and said, look, even those of you who are 250K plus, you're going to have your money back. We're going to give it to you. Now, the bank itself won't be working as is, but you will have access to your money. Don't worry about it. Okay. But what they also did was they quietly shut down a bank called Signature Bank. And if you don't know, Signature Bank is actually a pretty heavy lender in the crypto space. Many of the crypto entities like Circle and Paxos and Coinbase have a lot of funds in Signature Bank. I think Coinbase had about 240 million, and Circle itself in SVB here, Silicon Valley Bank, had 3.3 billion. So the crypto industry, these exchanges that are relying on the safeguards, the safety of traditional markets, actually got hosed, because that's where their assets were stored, was in traditional markets or traditional bank. And so they quietly closed the Signature Bank. This is worse for the crypto industry because a previous crypto related bank, a heavy lender, Silvergate Capital, recently voluntarily went, well, voluntary is kind of a quote unquote, right? It kind of had to cover its assets, liquidated. And so now we've got these two major lenders in the crypto industry that are gone, and now there needs to be other partners that come in and kind of make things happen. All right, and so there's a major platform called Signet, and Signet is like a payment platform that you can do settlements right away or quickly. That's what all of these Coinbases and larger entities were tied up in, were using, and that is actually the problem here with SVB and whatnot. It kind of, as those collapse, Signet collapsed, and now there's big chaos there. But look, there's a couple of things I want to cover here. All right, so those two things happen. The Fed actually stepped in and they created a separate facility. They said, look, this bank is not going to be functioning, but we're going to create a different entity that's going to get loans and will provide loans in up to 1 year for all these institutions that obviously have more than 250K in there. All right, so they want to prevent all these widespread failures. So if you look at when Celsius went down, Terra Luna went, Celsius went, then Three Arrows Capital went. So all these things start to domino effect because they were linked in together. So when one point of access fails, it's going to hit the rest of them. So that's what happened here. But here's what I find funny, right? And we'll cover it down here. It says, today, we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. This was a statement from the Fed board here, Jerome Powell, and Secretary Janet Yellen, Treasury Secretary Janet Yellen, and also the FDIC, which is the entity that provides that insurance, Chair Martin Gruenberg. So that's crazy. So by providing more loans to support entities that couldn't cover those loans to begin with, now there's public confidence in our banking system. And it's actually funny, if you look at the futures market for the stock market, they're all up because now people are feeling okay, but it's all positioned based off of loans and fake money. That's the crazy part. The safety, the public confidence, the strength in the industry is based on fake money. It's mind-blowing, right? When you see this stuff. And so it just goes on to detail, look, the Fed facility, the new separate entity they created, will offer loans of up to 1 year to banks, savings associations, credit unions, and other institutions, basically lenders. And then those taking advantage of the facility will be asked to pledge high quality collateral, and we won't go further into that. But even that's a slippery slope, because even those things might not pan out, and which would then cause further issues. So they just, like this action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. The Federal Reserve is prepared to address any liquidity pressures that may arise. So what does that mean? Let's that basically means we're ready to print money as needed. That's, if there's an issue with liquidity, meaning there's no cash in the system that's not greasing the wheels, they're fully prepared to pump that into the system. look, this whole quantitative easing is what got us to this point, and this is going to continue. It is too far down the path for this to stop, because the entire system is built on a deck of cards or a house of cards. It's not real, and you remove one card and everything just falls apart. And that's what was going to happen here if they didn't step in. But what they're doing is essentially kicking the can down the road. And you know, at some point something else is going to happen that's going to mimic exactly what's happening today, and they're going to have to step in and do the same. This process will not stop. It cannot stop because the entire system is built on it. So, having said all of that, what's the point here? The point is when we're talking about Bitcoin, we're talking about assets that you can actually own yourself. Keep them as cold storage. You don't lock them up in a third party, and a bank is a third party. And now everyone is seeing that counterparty risk, meaning the risk of the third party itself, of the entity that holds your assets. A bank is no different. It still has counterparty risk. Maybe not as much, obviously, as a newer entity or a startup, obviously, or anything like that. But I mean, this you know, Silicon Valley Bank is the second largest bank to fail, outside of Washington Bank, I believe it is, in 2008, the financial crisis. And then you look at Signature Bank, that failing is the third largest bank. So hold your own assets, right? Keep it in cold storage. That is the best play here. Crypto, blockchain, and definitely Bitcoin, the value of it is only being exemplified by everything that is happening now. If you pay attention to this stuff, you're actually going to see more value in Bitcoin itself. It's trustless. I don't need anybody to you know, give me permission. Nobody can censor it. It's borderless. It's all of these things that the banks are not. So keep that in mind when you see these things. And what's always going to be highlighted is you read things about Signature Bank and they're going to say, oh, it's crypto heavy and that's what caused the issue. That's not what caused the issue. Okay, obviously the value of the crypto assets have fallen, but the system is not set up to succeed without printing money. It's not. And the way that they maneuver and the things that they do, they being all those, you know, involved in the financial system, man, it's set up for the select few, and it's set up for them to win, to get their money. I mean, execs were paid before Silicon Valley Bank went under. They took a bunch of bonuses, right? Now, look, if the employees took it and it eased some of the pain for them at that time, yeah, maybe I can see that. But the execs they're selling their shares and doing all kinds of things. So anyways, we're not going to get into that. At the end of the day, you know, not your keys, not your crypto. Hold your own assets in cold storage. That is the safest bet. And we can avoid this stuff going forward. There's going to be many, many trickle-down effects, even to the bailouts that are happening now. And we're going to see where this can's going to get kicked down the road and what's going to come up at that point.